You've heard the advice 1,000 times. Buy the S&P 500, hold for decades, retire wealthy. It sounds foolproof. The historical data supports it. And yet, the majority of people who follow this exact strategy still manage to lose money relative to what they should have earned. This isn't speculation. Research firm Dalbar has tracked investor behavior for over 30 years. Their findings are uncomfortable. The average equity fund investor earned roughly 6% annually over the past 20 years, while the S&P 500 returned closer to 10%. That a 4 percentage point gap is called the behavior gap. It represents the difference between what the market delivers and what investors actually capture. Over a 30-year investment horizon, that gap doesn't just cost you money, it costs you your retirement. Let's put real numbers on this. If you invested $50,000 and earned the market's 10% return for 30 years, you'd have roughly $870,000. But if your behavior reduced that return to 6%, you'd have only $287,000. Same starting amount, same time period, same underlying investment, nearly $600,000 in lost wealth. That's not bad luck. That's self-sabotage with a brokerage account. Here's what's actually happening. The first trait of investors who lose money in the S&P 500 is panic selling during market downturns. The data here is brutal. JP Morgan research found that missing just the 10 best trading days in the market over a 20-year period cuts your returns nearly in half. Miss the 20 best days, and your gains practically disappear. Here's the problem. The best days almost always occur during periods of maximum fear. March 2020, when the market crashed 30% in weeks, also contained some of the strongest single-day gains in history. Investors who sold in panic missed the snapback. They locked in losses at the bottom and watched from the sidelines as their portfolios would have recovered within months. They call it protecting their capital. You call it crystallizing a loss at the worst possible moment. The math is unforgiving. If you invested $10,000 in the S&P 500 in 2003 and stayed fully invested through 2022, you'd have roughly $64,000. If you missed the 10 best days, you'd have roughly $29,000. Miss the 20 best days, $16,000. Same investment period. Dramatically different outcomes. The market rewards patience and punishes emotional reactions. Most of those best days occurred right after the worst days, when fear was highest and selling pressure was strongest. The second trait is performance chasing. This is the investor who piles money into whatever performed best last year, last quarter, or last month. They see tech stocks surge and shift their allocation. They watch international funds rally and suddenly want global exposure. They hear about cryptocurrency gains and wonder if they're missing out. This behavior guarantees buying high. Research from Morningstar shows that funds receiving the largest inflows typically underperform over the following 3 to 5 years. Money flows to last year's winners, not next year's. Investors consistently arrive late to the party and leave early from the next one. The third trait is overconfidence in market timing ability. Surveys consistently show that most investors believe they can identify when to get in and get out of the market. The evidence says otherwise. Studies from behavioral finance researchers show that individual investors who trade frequently underperform buy and hold investors by significant margins. They pay transaction costs. They trigger tax events. They make emotional decisions disguised as strategic ones. They call it active management. You call it paying extra to earn less. The fourth trait is obsessive portfolio monitoring. This sounds harmless, even responsible. But research shows that investors who check their portfolios daily are significantly more likely to make changes than those who check quarterly or annually. More changes means more opportunities for emotional decisions. More emotional decisions means worse returns. Checking your portfolio doesn't make it grow faster. It makes you more likely to interfere with its growth. Here's the profile of the investor who loses money in the S&P 500. They buy during euphoria when headlines celebrate all-time highs. They sell during panic when media coverage turns apocalyptic. They chase whatever asset class dominated recent news cycles. They believe they can sense market tops and bottoms. They check their accounts constantly and feel compelled to act on small movements. The emotional cycle runs like this. Greed during rallies leads to overbuying at peaks. Fear during corrections leads to selling at bottoms. Regret during recovery leads to buying back higher than they sold. Repeat for decades. Lose hundreds of thousands. Knowing this pattern doesn't automatically protect you from it. That's the cruel irony of investor psychology. Understanding behavioral biases intellectually provides almost no protection against experiencing them emotionally. You can read every study and still panic sell during the next crash. Here's how you avoid becoming a statistic. Strategy 1. Automate everything. Set up automatic contributions that invest regardless of market conditions. Remove the decision point entirely. You can't panic sell if the buy order executes without your input. Strategy 2. Write your rules before volatility arrives. Document exactly what you'll do if the market drops 20%, 30%, 50%. When fear is highest, you won't be making decisions. You'll be following instructions you wrote when you were calm. Strategy 3. Understand what you actually own. The S&P 500 is 500 companies. When the index drops, you're not losing money. You're buying those companies at a discount. Reframing volatility as opportunity changes emotional responses. The counterintuitive truth is this: boring investors build wealth, exciting investors destroy it. The person who buys the same index fund every month for 30 years without checking, without adjusting, without reacting, almost always outperforms the person paying attention. The market rewards those who show up consistently and punishes those who try to be clever. Your financial future depends less on what you invest in and more on how you behave while invested. The S&P 500 has made millionaires of ordinary people who did nothing but contribute and wait. It has also drained the portfolios of sophisticated investors who couldn't resist tinkering. The difference isn't knowledge, it's temperament. The traits that destroy wealth are predictable and preventable: panic selling, performance chasing, overconfidence, obsessive monitoring. Identify which ones describe you. Build systems to neutralize them, not tomorrow, today. The market doesn't care about your intentions. It only rewards your actions. Choose your investor identity accordingly.